Guys, and welcome back to the channel. So today's another special episode where I'd like to talk about macro or rather top-down investing, right? So if you have been watching my channel, you would know that I'm more of both. I take both into account, right? Both bottom-up approach and top-down. So bottom-up is your fundamental analysis where you look at your financial statement trends, your quality of products and services of the company, right? Your individual company's narratives, any story that will help drive its valuation expansion, things like that, versus the industry, versus its competitive industry, things like this. So not just from the company level, but you can also account for narratives at the whole sector circular level, right? And then the quality of the management. Is it still founder run, right? How much stake does the founders and management has in the business? Any insider trades so far, and who are the owners of the company? Is it already institutionally broad-based owned, or it's still heavily concentrated to the founders, right? So all of this you can find out through looking website like Stock Penguins. You can deep dive into the company's valuation matrix, key ratios, looking through its earning calls, right? It's haven't loaded yet. Yeah, looking through its earning calls, what happened in this, right? Looking at its financials, balance sheet, cash flow, financial growth, historical earning performance. Did they historically beat very often, or did it miss often? So these are the kind of things I looked at. The company's recent news, things like this, right? So these are the things that you look out for from a bottom-up perspective when you're trying to stock pick. But I think accounting for the top-down approach is very important. So top-down, generally a macro analysis, right? It's basically you're looking at your economic, the status of the economy, which part of the market cycle we are at. Are we still expanding? Are we reaching close to the peak? Are we close to the bottom? Things like that. And why this is important, because it helps us to understand generally where liquidity is flowing, right? Where is money flowing to? Are we in a risk-on environment or in a risk-off environment? This is very important because it will let people reassess their portfolio, their risk management, and then they will rebalance their assets. So you'll see money flow from your bonds to your stocks and gold, to your crypto, and vice versa, right? So all this will generally affect the demand for these different financial products and assets, and this will be reflected in their prices as well. And I think another thing that's very important, right, is all this macro analysis, your economic indicators will give you the clue to what the Fed may do, right? So the Fed actually historically looks into unemployment rate and inflation numbers to decide if they should adopt an expansionary or contractionary policy, which I will explain more later, which basically affects your liquidity flow and your overall business sentiments and investors' sentiments as well, which again leads down to your assets rebalancing. So I think this is also very important because the mother market today takes a lot of cues from the central bank, right? Especially setting your interest rates. In recent times, there has been a lot of eyeballs on what the Fed may do with their rate cutting plan, and which is why you see markets have rallied quite aggressively when the Fed more or less said that they would be looking to cut further for the remaining of the year, right? So top-down macro analysis, I think like I mentioned, macro analysis is important because it gives us an understanding of where what the Fed is doing, and also where liquidity flows. So if you recall in my previous videos, I talked about this chart, right, where on the y-axis you get the balance sheet of the Fed, and on the x-axis you get the interest rates. So we want to invest in times where it is most liquid, and maybe avoid investing that much in periods where it's least liquid. So where your balance sheet is high, meaning your Fed is quantitatively easing, right? It's adding more assets to its balance sheet, and when your interest rate is low, when it's cutting to spur the economy, right? So these are the areas where you can potentially find out where to invest. So before you deep dive into the macro analysis, which is basically just understanding your economic indicators, you need to understand that data points are all correlated. So you can't look into one single data point as the most decisive factor. So for example, you can't just look at employment rate by itself to understand where the economy is going. You have to take into account employment, inflation, economic activities, all this together to create like a more comprehensive and overarching view of where you think the economy is headed to, and then as a result, what the Fed may do, right? And number two, so not all data points are important. So if you look at Forex Factory, I use Forex Factory a lot to let me zoom in closer to tell what's happening for the day and for the week ahead. So Forex Factory would actually give you the forecasted data, previous data, and the actual data when it comes out. And they also give a weightage to the impact of the activity. So usually I only care about the high impact and the medium impact. The low impact ones I already filtered it out. You can add it in if you want to, but you get a lot of data points which may or may not move the needle, right? So I only take into account the high impact and medium impact economic indicators, right? So there are weightages to these data prints, which I use as the impact, the severity of the impact as indicated on Forex Factory as a guide, right? And you have to understand at the same time which data points are most important in the current market cycle, narrative, and structure. So I think if you go back to the start of the year, early half of the year, all the market care about is tariffs, right? What are the impacts of Trump's tariffs on businesses going forward? And then this brought a huge big sell down in stock prices. But today, as of end September, the market has more or less moved on from tariffs, right? Any tariffs announcements or any discussions are basically ignored by the market. What is more important now is the interest rate cuts by the Fed, and any data points that would support or maybe dissuade the Federal Reserve from cutting rates, right? So you have to take into account current market sentiment and dynamics, and also play accordingly in terms of understanding the severity of all these economic indicators and prints, right? So don't just take all these data prints, right, as a wholesale number, but put it in context. So I think how you can put in the context is over time just keep in tune with the market, right? Which I usually do by looking at news, right? But at the same time, you have to also be aware that news is just a platform for your media institutions to draw eyeballs to them. So you at the same time you have to also over time get the experience of differentiating facts from just news and from just a hype and fear, right? So these are the things that comes with time. So the most important thing is to practice and keep in tune with the market, right? And number three, each type of data points could have different prints. So like for example, for jobs, right, there will be many different types of data, like your job opening, unemployment rate, unemployment claims, things like that. But it's very important to think into account the most important one. Just think of the 80-20 rule, right? So 20% of this data make up 80% of impact. So I think over time, as you look more into the definition of all this economic data, you understand what is more important than the other. But as a proxy, you can use forexfactories.com impact severity color guidelines as the signal for how impactful an economic data print may be, right? And lastly, a single data point does not exactly determine the Fed's action, so there needs to be a trend. So especially for Powell, right, he's someone that likes to see more data points to confirm the trend of whatever is happening right now, whether inflation is getting hotter, whether it's sticky, or whether there's like 100% weakness in the job market, things like that. So a single data point may not determine the Fed's action, but a single data print may create some volatility around when the news is announced, right? So we'll talk about that later. So let's talk about the type of economic data. So I usually lump them into four of them, right? So your raw GDP, which is the general output of the economy. By itself, it may not be that important because it's only released every quarter. And I think what is more important is the data leading up to this computation, right? So the contributory data points, this is what the Fed actually monitors as well. So I think which is what you must do as well if you are an investor looking to time the market to get outsized returns, right? So and another thing is the absoluteness of all these economic data numbers by itself may not generally mean much, but it's how the actual data performs against expectations that is important. So did it beat to the upside or did it miss to the downside? So all these shocks to expectations, right, actually creates volatility in the market, which you may or may not exploit. So for example, we got a very bad inflation print. So and then the stock market just dumps. So this may create an opportunity for you to get into the market if you believe that this print may be one-off and actually the Fed will not deviate much from its interest rate cut path, right? So this may be opportunity for you to enter the market. So all this, data, one-off data points, data results, right? How it performs against expectations is the more important part versus the actual data itself. Because nowadays, as more participants join the market, we are more knowledgeable, we get more access to information faster. The market has become a lot more perfect, right, in the sense where data prices and all this get priced in very fast. So but there is still opportunity out there, but just saying that it is a lot things get priced in faster now. So actual data prints may not deviate that much from may not cause that much volatility unless there's a huge variance in performance against expectations, right? Another thing to note, which is what I mentioned earlier, the Fed can adopt two forms of policy setting, right? Number one, expansionary, where they're looking to reduce interest rates and put on a more quantitative easing kind of approach. So all this is to create more liquidity in the market, to reduce interest rates, to allow to spur more economic activities, right? So as your interest rate goes down, your capex, right, all your borrowing costs to fund your new projects, buy new equipments get lower, right? And it just gives more motivation to fund new projects. And also as interest rate cuts, right, your yield on all these treasury products, your bonds may get lower, so it may spur people to invest in more aggressive risk-on assets like stocks to get better returns. On the flip side, on a contractionary environment, right, is where the Fed increases interest rates and adopt a quantitative tightening approach. So what it does is completely opposite of that of expansionary policy setting environment, where here the job of the Fed is to look to cut in look to fight inflation, essentially, like what happened in 2022 and 2023, where the Fed increased interest rates very quickly to fight off inflation, where at the point that I think it hit a high of around 9%, which is crazy. So they had to increase interest rates to fight off all this inflation pressures. But as your interest rate increase, this means that your cost of borrowing gets higher to fund your new projects. So business sentiments may get affected, and at the same time, your treasury yields get a lot more attractive. So investors may move on from risky assets and rebalance their portfolio and reallocate more of their funds towards treasury yields, which a lot safer and you get higher returns now. So why not, right? So looking at the data points, so inflation, right? We have CPI, which is just a key economic indicator that measures the average change over time in the prices of a fixed basket of goods and services commonly purchased by resident households, right? So there is a year-on-year and a month-on-month data print for this. So the longer-term data, which is the year-on-year, is more concrete and less volatile. It gives you better idea of the trend. And the month-on-month, it's more, I think there's more volatility and, prone to a lot more randomness in its prints, right? So the Fed's long-term target for inflation is 2%, but deviations are normal. So if you get maybe like a plus minus 0.1 to 0.2% is okay, right? So this is it for CPI. So core CPI is basically your CPI, but it excludes the prices of food and energy, which is the most volatile item. So I think core CPI gives you a better sense of actually what's happening out there in terms of prices of people, right, on their daily living. And number 3, PPI, which is the price paid for manufacturing goods. It is a leading indicator of CPI. So all these businesses, right, may pass on down the cost to the consumers when they have an increase in terms of the prices they pay for their own goods as well. So that's why it's a leading indicator for CPI. So the Fed's action plan, if you have high inflation, like I mentioned earlier, they will look to raise interest rates and they'll look to raise interest rate and adopt a quantitative tightening approach. So when this happens, right, hopefully the best case scenario is where your inflation comes down, your interest rate goes up. So usually in this case, like what happened in 2022 and 2023, it's not that good for the stock market, right? Neutral inflation, well, I assume it's 2%. You actually can just stay at where you are in terms of interest rate. And if you have low inflation, it could also mean that the economy is not doing that well because there is no demand. And if there's less demand, obviously the prices of your goods will go down to match your demand, right? So the Fed will usually adopt an expansionary policy, which involves cutting interest rate and adding stimulus to the economy. So here is where you see risk assets start to become favored again, where stock market starts to rise up, like what's happening right now, where the Fed is cutting interest rates and we're seeing the stock market rally quite heavily, right? Number 2, jobs related. So unemployment rate is just basically how many people are unemployed versus how many people who are unemployed but are seeking for jobs versus the total workforce. So a low number indicates a stronger economy because there's more need to hire people to fulfill demands by matching supply, right? So this is just a guideline, right? Usually, if unemployment rate is more than 5.5%, it's weak. 4 to 5.5% is okay. Less than 4% is very strong. Another data point for jobs is initial jobless claims, which basically is how many people are filing for unemployment insurance for the first time in the past week. So it is a leading indicator for the unemployment rate. So if you see higher initial jobless claims, it means that the unemployment rate may start to tick up over time, right? Non-farm payroll is another one. It measures the number of jobs added or lost in the non-agricultural sector of the American economy, excluding jobs in farming, private household, and non-profit organizations. So obviously, the more job added, the better, right, for the economy. So like I mentioned earlier, a weak job market expansionary policy, the Fed will look to spur the economy by cutting interest rate and adding stimulus. Normal, you probably won't look to change the status quo that much, right? So the interest rate probably stays. Strong job market could indicate like a very strong economy, which could lead to a lot more people spending on goods and services, things like that, and it leads inflation to go up again. So the Fed may adopt a contractionary policy approach where they raise interest rates to fight off inflation. Right. Number 3, economic activities related, right? So some of these are like your consumer confidence, your manufacturing and non-manufacturing PMI. So what's here important is that consumer confidence is a leading indicator to get a better sense of the unemployment and inflation in the future. So it's basically a monthly survey conducted on households for sentiments of their income, business conditions, and employment status. 100 to 200 neutral, above 120 strong, below 100 weak. Right, so this you can use this as a leading indicator and the proxy to determine your unemployment inflation rate as mentioned. B, your manufacturing and non-manufacturing PMIs. So above 50 usually indicates an expansion, below 50 indicates contraction. So I think the two most prominent ones is your ISM at Chicago for the US, right? Services are also more important because it contributes more than 70% of the US economy and generally more sticky, right? All this kind of data. Right? So, like I mentioned earlier, weak economy, expansionary policy adopted by the Fed. Normal, neutral, doesn't have to change anything. Strong economy, you may look to adopt a contractionary approach to cool inflation down. So, economic activity actually has an impact on inflation and job numbers. Actually, all three of them are in like an interweb of they're all correlated, right, as mentioned. So I think all this data is important to get a sense of where we are now in the market cycle, in the economic cycle, to get a sense of where and what the Fed is thinking and planning to do. So expectations based on where we are now is a lot more important than predicting what will happen next or predicting the next economic print, right? Because there's no point in doing so. Like even the Fed got it quite wrong back in 2022 and 2023 where they kept interest rates too high for too long, right? So I think as a parting tip, I think there's no point trying to predict your economic data, right? But I think it's just to understand and read all this data, all these data points, to understand where we are now, and what are the possible paths going forward, so we can risk manage properly by rebalancing the portfolio. There is, in a sense, it's just to get a understanding of whether I should be more offensive or defensive in terms of my portfolio construction. So that is all for today. Thank you.